Oil down sharply today, down 8%. Looks like a lot of risk premium had been built in. Iran hit back at the Americans with a missile attack on a base in Qatar. That was seen as limited in its scope, perhaps even just symbolic. Our guest has investment ideas for those who are looking for additional exposure to aerospace and defense. They have outperformed the S&P 500 this year. We're joined by John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. John, give us the big picture first. The world is going to be spending more on armaments? It seems certain.
It would appear so, Andrew. I've got to say that where we are right now, while we think there's been really some progress in disarming an unstable nation from becoming powerful to have its own nuclear weapon ready to roll, we think that it remains an uncertain world, whether it's Russia, whether it's China, or just the various smaller nations that have some things that go all the way back for many years in the different continents that are still. There's going to be a business for armaments is going to continue. And that's within the industrial sector. It's also a sector that's very much affected by advances in technology that allow weaponry to be more accurate, but at the same time, avoid putting more troops on the ground. So keeping soldiers out of harm's way in many ways and being able to disarm things like what we saw over the weekend in terms of the nuclear facilities is really a remarkable thing, considering the containment to avoid contamination of any nuclear fallout.
I'm looking at one ETF here, ITA, iShares, US Aerospace and Defense, and that one up in the past year, 36%. So certainly investors have been buying into these stories.
Oh, certainly have. So what we would say here is, the way to buy these is at this point, we would say these would be something you wouldn't dedicate a whole portfolio to, but naturally would be part of a portfolio for consideration as part of a portfolio, depending upon one's objectives and tolerance to risk. But basically, if you own the industrial sector, you get exposure to a lot of the larger companies that are in the S&P 500, and then you can do a special focus within the sector by utilizing an ETF like ITA or like the other ones, the Invesco Aerospace and Defense, or the iShares USA Aerospace or SPDR S&P Aerospace. So it really gives you opportunity that some of these portfolios are equal weighted, some are market cap weighted, and so you get an ability to really accentuate your position within the aerospace defense area as well as military equipment, basic on the ground stuff.
I just looking at your
dividend too. By the way, there's a dividend with many of these larger stocks too.
Sorry, John, cut you off there. So looking at your investment strategy, in some ways, it's kind of counterintuitive. You're saying overweight cyclicals versus defensives. And I mean, people are worried about the economy with the trade war, but also maintain overweight U.S. exposure, which is interesting, given we've heard a lot about, some investors are fleeing the U.S.
Yeah, Andrew, I think I think this fleeing the U.S. is way overdone. U.S. exceptionalism is based on accountability, governance, and transparency within the U.S. system, and a record of paying its debts as we go along, and checks and balances. I mean, we've seen recently with the new administration as well as the administration that preceded it. Nothing could ever be done by any administration without the opposition being able to air their opinion and sometimes really change the way things are actually done. So we think the U.S. remains the overweight, particularly for U.S. investors, but we don't think it kills the appetite for foreign investors. I think it was Bill Gross who said, in fact, I know it was Bill Gross who said that if all the countries in the world are dirty shirts and a hamper of dirty shirts, the U.S. is the cleanest. And well, with all respect, I don't think that necessarily applies to Canada. Canada equal in many ways to the U.S. In terms of being a clean shirt. But when it comes to the U.S., the innovation that we're able to produce is as a result of our protection of patents, are the attractive ways about our economy. And in terms of our slowing, Andrew, the Fed raised rates for 11 times, kept them on pause for 9 FOMC meetings at the higher levels. We went from 0 to 0.25% as the Fed funds band to 4.25 to 4.5. No recession yet. They began to cut last year in September, 50 bips, 225 bip cuts respectively, November, December last year, and a good chance we believe that we'll see the Fed cut at least by September. And then once again, part and parcel of what we consider to be a down payment for the Fed to tell the market, to tell the more leveraged segments of the economy, don't worry, we're normalizing interest rates. You're not going to get back to free money the way we were during the emergency periods of the great financial crisis or of the COVID-19 pandemic. But interest rates will be trimmed a little bit. And we think they're going to do it without a recession. We believe this in 22, 23, and 24 into this year, and we're still that way. We don't think we're going into a recession. We think this Fed, Bernanke legacy is the way Jerome Powell is operating, high sensitivity to the effects of the Fed practicing its mandate of both producing an economy that can grow at an attractive pace without creating high levels of inflation, but at the same time, not causing high levels of unemployment.